still expecting quite a few people on this call today. It's great to be able to do this with you, and in these unprecedented times, to have this technology and this ability to communicate with you. I think this is our 8th webinar we've been doing. We've got one now this morning. We've got another one this afternoon. They've been extremely popular, so it's been great to tell our story, when we can't meet face to face. What we will be doing is we will be sending a copy or a link to a recording of this webinar, and then also a link to a copy of the presentation, which we'll send to you after. And yeah, so once again, it's great to be with you. I'm Brian Duplessis. I'm Head of Marketing and Distribution at Rezco Asset Management. With me on the call, I've got Rob Spanjaard, our Chief Investment Officer, and Simon Sylvester, who's our Co-PM and Head of Research. It's great to have them with us today. And basically what we want to do today is we just want to unpack some of our current thinking, how we're seeing the markets, what's caused them to do what they've done, the extreme volatility. Is it a V? Is it a W? That's the question everyone's asking. Where to next? So it's great to be able to do this. There is just some housekeeping rules per se. At the bottom of your screen, there is the opportunity to ask some questions and answers, and Simon will be manning that, and we will get to those during the presentation, and then also after the presentation, there'll be some time for some interaction. So I think we could go to the next slide. So what we wanted to do as well, before I hand over to Rob and Simon, we just wanted to give you an overview of our funds. What funds have we got? We've got a suite of funds, and you can see at the bottom, we've got multi-asset low equity, where our stable fund is. Then we've got our multi-asset high equity, the Rezco Value Trend Fund, the Managed Plus. And then we've got our general equity fund. And then we've got our global fund, which is US dollar and UCITS compliant, based in Luxembourg, with the feeder fund, the corresponding feeder fund. So what we've tried to do is we've really tried to create a suite of funds to cater for all investors. So we could go to the next slide. So we don't want to brag, but it's nice. It's nice to to talk about this. We're not running the funds to get awards or to be number one. Everything we do is part of a process, a philosophy. Essentially, what we're trying to do is we're trying to manage risk. It's great as a result of that, we can beat our chests with these fantastic quartile rankings. You can see that the funds have done exceptionally well. We've also, the Rezco Value Trend Fund started in 2004. It's top quartile. It's got a 10-year annualized return of 11.8. I think it's second out of all the funds over 10 years. What's really nice is that fund that started in 2004. It's been around through various market cycles. It's not like the fund started in the bull market after the GFC. So that's great. Our stable fund as well, what's very nice is that it's just come onto a 5-year track record. It's the best performing stable fund over 1 and 3 years, and with a 1-year return of 16.9%, which I think is great in these uncertain times. And then our equity fund as well has also just come up with a 5-year track record. It's had a 1-year return of 0.63 when the market's been down 9%. I know it has recovered, the market has recovered somewhat. That fund, we committed to being 90% invested, so it's very difficult to do active asset allocation, which is a hallmark of our other multi-asset funds. And then also what we're very excited about is our global fund. Our global fund started in 2015. It's, like I said earlier, it's US dollar denominated and based out of Luxembourg. And then the corresponding feeder fund, which has done exceptionally well over 1 year. It's done 32%. That's in the CISA multi-asset flexible category. So if we go on to the next slide. So very important, how do we access these funds? How do you access the Rezco funds? We've really tried to make the Rezco funds as accessible as possible. I was at Rezco when the funds weren't on the platforms, and we know how valuable these platforms are to us, and that's why we really try and partner with these platforms. So most of our funds are either on the open architecture or the front end per se. If they're not available on the front end, they will be available on the back end. I think what's important is if there is demand for one of our funds that's not on your preferred platform, please let us know, and we'll try our very best to get you access to that fund. And also, very importantly, the pricing. We believe in partnering with these platforms, and that's why we've put our clean pricing on most of these platforms. If you've got any questions about the pricing, please contact us, and we'll be glad to talk to you about that. We could go to the next slide. So something which we're very proud about is our client spread. So we've done a lot of hard work through the years to grow this, and obviously we want to grow the business, but we've been very fortunate to gain a spread of clients through the years. What's important to us is that there are over 3,600 advisors that are using the Rezco funds. So once again, I think we'd like to just take this opportunity as well to really thank our clients for their continued support over the last 16 years. So it's great to have our biggest decision maker there is 2.2% of our total assets under management. So that's very comforting, and it's a great place to be as a business. If we go into the next slide, the team.
I'll pick up from here, Brian. Thank you. It was prearranged. I'm not cutting. Brian said I must talk about, because the core of the issue here, we're busy building a great team of investment professionals. That's the red crowd in the middle there. And there's some really great people working for us, really intelligent, sharp, well qualified. And obviously we've got the green is a great ops team. The red are mostly based in Joburg, in Sandton. And the green are ops is in Port Elizabeth. Then obviously the blue guys on the left are sales team. But the core of what we're all trying to do there is really probably comes out in the slide. We're trying to balance risk and return. Those who've known us for a while, it's about trying to get risk-adjusted returns for our clients. So we're sitting, working, when is return, potential upside there, is it worth the risk? And sometimes if you take no risk, you never get a good return. So we never want to be like, the broken clock that you write twice a year. So for example, last year was a great, our funds did incredibly well. In a toughish market, but we found the opportunities, we found the places where it's worth taking risk, and got the return. At the beginning of the year, we took certain actions that also the risk reward didn't really add up. So we de-risked a lot of our portfolios. And you can see it from this slide here. That's value trend with a 15-year track record. We very similar event here, and we've titled avoiding grey rhinos. So we'll talk a bit later what grey rhinos are. But that's the current Corona crash, if we can talk at that. And then back here was the GFC. And managed to try avoid, because we're active asset allocators, and it's part of our process that actually just unfolds. Try not be there when there's really big trouble. I'll talk a little bit about that, and it particularly how it applies to the current market, because we think that's important. But it's a very important point to note. It's not that we just do well when there's a crisis. Probably our best relative performance, the yellow there's our peers, the blue is our share index. It's a Reg 28 fund. The best relative performance was in fact after the GFC. Coming out, we obviously didn't fall. A lot of competitive funds would have just fallen and come back up again. That's obviously the index. We could afford to wait, and then really from about 2010 started to outperform very significantly. So we're not just fair weather friends. We do well through the various cycles, just trying to balance a risk return. And one of the things we do on our asset allocation funds is we manage the asset allocation fairly actively. We think that's important. It's fine when it's a raging bull market and everything's going up, then don't bother. And so you can see a period here from about 2011 to 2015. We had a very reasonably static asset allocation, a couple of ups and risk on, but essentially that's a great time to make returns, and you sit there. You're not trying to be contrarian. But then there are periods, you can see the GFC there, the first down, and then similar to what we did now in the Corona crash, worth taking a lot of risk off the table. really our understanding here was the risk return just didn't add up. But you can see even before the global financial crisis, we took risk off table prior to that as well, and then put it back on. You've got to be understanding, looking, trying to find the reason why you're wrong. And then we do a lot of that. We do a lot of thinking about that. So how did we come through this period? That's Rezco Value Trend Fund. All of the rest of the next graphs are 3-year graphs. The red line is Value Trend Fund. This is to the end of April. The yellow is peer group, the blue is all share index. Then obviously the sectors here, the CISA multi-asset high equity sector. So you can see even with the rally that we've had during the month of April, the fund actually did quite nicely. That's given a little bit of the relative performance, but still pulling nicely ahead. And we think that's the hallmark of this market might be a bit of if you remember the parallel of the tortoise and the hare, just not giving it back. The tortoise won that race, and you've just got to be banking your returns, adding a bit of risk, taking a bit of risk off. And we think this is a process, and we're going to have to work it out over a while. You can see our Managed Plus fund actually been doing slightly better than Value Trend. It's in the same sector. Also rallied nicely, and the market bounced back, still pulling away. Our stable fund, we think, is doing a great job. That's the red there. The blue is the CISA flexible income category. And you can see that the concern when there's a crisis is that income funds aren't as safe as everybody thought they were. And you have a bit of a hit. The yellow is the peer group. Now, that's disappointing, but we think stable funds have got a very important place in portfolios that wanting low risk, and certainly we think we're achieving it there. Our global flexible feeder fund also done really nicely over that period. That's only was registered a year ago, so that's hence the 1-year record there. And that's our equity fund. So you can see it rallied. It didn't fall as much when the market fell, but it rallied as much as the all share index when the market rallied, and actually rallied more than the peers. And it's a trick. You have to be invested. It's a tricky market. Try and not get hurt. We hate being down, but you know, equity fund, you need to be invested, and you need to just be finding those opportunities. And if you look hard, you can find them. Just briefly, that first slide had grey rhinos at the top. What on earth are we talking about? This really comes from the mirror image of the grey rhinos, the black swan. Now, Black Swan was a book written by Nassim Taleb, and Grey Rhinos is a book written by Michelle Walker. Now, we've been following a mindset of grey rhinos. And in fact, the Chinese government have actually been using it. It's not some arbitrary book, but using the terminology grey rhinos. But now, weirdly enough, last week there was an article where Nassim Taleb was saying there's no ways the corona crash and coronavirus was a black swan. In fact, he was rather scathing about anybody who claimed it was a black swan. So that's even Taleb doesn't think it's a black swan. But it does give us sometimes a place to hide where everything's a black swan. And we believe active asset allocation is important because sometimes these things are fairly fair. You can see them coming. So grey rhino is just a highly probable, high impact, yet neglected threat. It's not a random surprise, and there's normally a series of warnings and visible evidence. A rhino, you see some degree, it's a bit of an early warning. Early warning that there's a rhino, you can get back in your vehicle, you can climb a tree, you can take evasive action. But the important thing is it's got to be part of your process. If you're totally static, you can't do that. It is part of our process. We're trying to think about it quite a bit. You know,
Rob, just to jump in, Rob, just to remind everyone, there's a Q&A button at the bottom of your screen there. So you'll see it there at the bottom. If you click it, you can type a question. I'm manning it. We'll answer some of the questions live when they're on topic. Some of them we'll keep for the end, or I'll just answer as they become appropriate through the presentation. So please do use it. We like being interactive. We want to answer your questions. So that little button there, type your questions. I'm watching it closely and we'll pick them up.
Yeah, thanks, Simon. We found that quite helpful in the other presentations, because sometimes a very good question that everybody's thinking, and it's actually worthwhile to deal as we go through it. So just talking briefly on that grey rhino black swan thing, we have a very deliberate risk framework which starts in the middle here, where we're trying to find asymmetrical risk reward shares, investment opportunities. That's why we aren't benchmark cognizant. But you're trying to find it at a portfolio level where there's shares that can go up a lot more without much downside risk. But then we obviously take all of that together and we blend it. We do a whole lot of portfolio construction, and we think about how does it combine as a portfolio. Or you can be very positive about SA Inc. shares, but you can end up with too many of them. And so we track themes, we track sectors. We don't just look at sectors. We actually have our own themes that we design, and then our portfolio management tools can pull it out. We look at the MSCI Barrier stats. Are you getting too much momentum, not enough value, too much growth? And we track it, because you don't want to start drifting from the style and get lured into something where you're actually just following momentum and you're putting a great label on it. And then the last bit is this grey rhino thing. So we don't want to give the impression we're just sitting there waiting for big macro events. As I said, we did probably our best relative outperformance after the GFC from 2011 to 2015. We're stunning outperformance, and that was pretty just normal bull market.
So Rob, just a question on the grey rhino that came through now, just on that probability distribution. I think it's important. So what way was COVID-19 a grey rhino? What could you see coming? Now, it's important so grey rhino, yes, there was information in China before the market was at a record high, and the Hubei province was in lockdown, and about 700 million plus people were on restricted movement in China. And you had that cruise ship off Japan, which told you this thing's very infectious because one person gave it to eventually a few hundred. So there was a lot of information out there and around the virus, and markets were at a record high. So if you look at that kind of probability of distribution, you got this kind of big probability that this virus escapes and there's a lockdown somewhere other than Hubei, whether it's London or New York or something like that. And we looked at the market saying, well, if you're at a record high, there's a pretty good probability, not 100%, but there's a decent sized probability that the market could fall a lot. And so that's why we're calling it a grey rhino, because it was predictable, but we're not saying it's these events, and it's important with macro risks, and when you look at probabilities and geopolitical kind of risks and so forth, they're not done with 100% certainty. That's why there's this risk framework and there's these probability distributions, and you've got to interact where the market is, what it's pricing in, and what your options are. So if you look at that probability distribution of the grey rhino, the market's at a record high. You got very little upside, but you got a lot of downside. Because coronavirus could have just been cured, it could have been nothing, could have stayed in China, in which case you would have had a little bit of upside because markets were at a record high. But if it escaped, you'd have all that downside, which is why all that probability to the left hand, kind of the middle there, all that probability of downside. That's why, that's how we manage kind of macro risk. We're not predicting with 100% certainty. But that being said, it was predictable as a reasonable probability high risk event.
But if it's, you see, why are we talking about processes? It's got to be part of your process. We don't think it was that hard to work out. But if you run static asset allocation, you actually don't really care. So you're not looking for grey rhinos or potential big hits, because if your asset allocation is static, it's just not in your risk framework. You don't have a risk framework for it. Where we have the standard risk framework, and we're trying to do it, and we think even a better risk framework, because we prepare to be benchmark non-cognizant. We're not benchmark cognizant. That we're not trying to build our portfolios to look like the index, sitting at a time when we fully invested. We prepare to deviate from it. But if, say, for example, you look at an equity fund, it has better, it falls less when the market falls, goes up when it goes up, but it's got much better volatility characteristics, which you can get from a good risk framework. So that's not, the equity fund doesn't really care about grey rhinos because it has to be invested. But the rest of the left two boxes there of your risk framework are very important to that. So it's all three in the process. But just highlighting what Simon said, it was very predictable, the corona. When you had that ship off Japan, you knew it was massively contagious. One guy from Hong Kong managed to infect 600 people who were locked up in the cabins. And as soon as you had that bit of data, there was a high probability event that you were going to go, that you had a risk of New York and London and the rest of the world. But not, there's very little upside. And that's a core of what we're trying to do. So we look at without losing too much time on the risk stats, we plot, that's our equity fund, that's the beta of the fund, runs at it's about 0.6 at the moment. The slide actually is a week or two, a couple of weeks old. Then we run the stats and we look at how does the stats of our fund work. What I think is very important to investors at the moment, how does the bear market play out? And look, even that slide would have some questions because some people think it's a new bull market. Technically, the amount that the market's gone up, certainly in the US, it's technically a new bull market. You can believe that if you want, and that's what makes a market. Certainly, we don't think so. That's hence the title of that slide. If we look at previous bear markets, we've split them into two categories with no recession, so no fundamental underlying problem. And there's 61, 65, 87, bottom left-hand corner there. Then 98 going down to 2018 at the bottom right there. 87, this bottom left, was the first one I managed money. I was managing a small fund. And when you look back on an historical graph, it looks just like a blip on a 30-year graph. Believe you me, it felt like a proper bear market. But what's important to note in all of these, no underlying problem in the economy, but all of them had to make a bit of a basing activity. So this concept of, in memory, when you look back, everything's a V because you compress the time span. The only one that was in fact a V was the most recent one, which was 2018, where the market was just being the market. There was concerns of maybe a bit of a recession sometime in the future, and the market took a big smack on. This is obviously S&P took about a 20% fall, no apparent reason. So it's only one that's a true V that fell, that went straight back up again. Is it a recession? Won't spend a lot of time on that. This is some Oxford economics numbers that are predicting, but somewhere between GFC over here and Great Depression. If we look, one of the problems on this is that Europe and America are still at the end of 2021. The economies are a lot slower, a lot smaller than they were at the start of 2020. Significant recession. IMF, which are normally fairly boring, are predicting worst blows since the 1930s to the world economy. And certainly we agree that if we look at the high frequency data, the stats, the market is still hard down. If you saw those US unemployment numbers last week, that's kind of the worst unemployment stats you've seen since the Great Depression. And we don't feel stimulus fixes everything. So then you get to the bear markets with recessions. Important to note here as well is that all of them, there's this basing activity. The markets, it's just, we remember them as V's, but they weren't V's when you go and look. We've just pulling out the most recent two. That's a 2000 bear market from the dot-com bubble going into 9/11, and then the GFC at the bottom there. We've taken those two and we've said, okay, where are we on the current roadmap? The red there's the current, the blue is the GFC, and the yellow is the dot-com bear market after the dot-com bubble. And you can see we're similarly on track. The rally we've had, leaving, I haven't put in last night's number, with the S&P down 3-4%. And essentially what we were saying over here, we were saying to clients, look, it's too cheap to sell. You can't switch funds, you can't sell here, it's too cheap. Over here, if someone said to you at the beginning of the year that this is what's going to happen, everything you had the newspapers from May in January, and the market was going to be 5%. You had an opportunity to get out 5% down. I think any of us would take it. So we've had this rally, very normal activity in a bear market. We think a better predictor is the roadmap of the GFC, or at least the 2000 bear market. Shares weren't cheap at the beginning of this year, and there's an underlying economic hit that's problematic. This is on the JSE. Now, if you feel your most accurate predictor, accurate roadmap of where we should be is the 2018 bear market. The market was down 9% for the year. Then you're about on track. We think the world situation, South African situation, is a little bit worse than that. And so we plotting that on longer term. We put the last 2 bear markets in. The blue then is again the GFC. The yellow is the 2002 where the bear market started here. And there's an additional line on there, which is the 1998 emerging markets crisis. And weirdly enough, we also just there back in the pack. And we again think probably the blue line or the green line are more predictive. Either way, this bear market's got a bit of work to do. And it's not all doom and gloom, and it's not something we hope we're wrong. And Simon and I debated a lot. What we're missing, is there some fact here? It is a very similar thing in 2017. We're going to some of these, at conferences and you're talking to clients and they're saying a lot of your competitors are seeing green shoots of South African economy. And we're not seeing it. Maybe we're missing something. And you go and you look, you get out your magnifying glass and you try to find the green shoots realistically. And this is one we hope we're wrong. We really, really do. And we're prepared to change our mind quickly, but none of the facts we see say that isn't the bear market. Is going to take a bit of time to work out. And the driver of this is corporate profits. So if you look in the US, you take this, the GDP being the red line there, you're predicting about it on the left axis, about a 6% hit to GDP roughly corresponds about a 10-to-1 ratio. You can argue it's 7-to-1, 10-to-1, but it's about a 10-to-1 ratio on this graph of that in corporate profits. So 6% hit to US GDP drops corporate profits by 60%, 50-60%, which is massive. Then if you take corporate profits, the hit to corporate profits being the blue line there, and equity prices, there's a similar about a 1-to-1 correlation, because ultimately, unless your price earnings ratio is very cheap when you go in, the PE already of the forward PE of the S&P is already significantly higher than it was at the start of the year. So corporate profits have a relationship to equity prices. You can see down here, they obviously turn before the equity prices turn before the corporate profits. Obviously, we're all talking to company management. Management starts to tell you, looking better. Last year was horrible. We've just announced our results, but yeah, the last month or so has been really good. Signs of green shoots. And we look at high frequency numbers as well, and I'll get a bit to that. If you just take the index itself, not percentage change, and trailing earnings, you can see there's a relationship. In the end, as investors, we're buying an earnings stream at a reasonable price, and you can always strip out. You can say, yeah, but if you strip out Amazon, Microsoft, Facebook, and your Google out of the US market, you do a similar exercise in South Africa and strip out Naspers, then it doesn't look so bad. The market has fallen more, but realistically, given the sort of hit, you can always do that with an index. Counter argument on that in the US, are US airlines even going to survive? There's a lot of shares that might even go bust. The point is, given that hit to corporate profits, year on year, the US market's about flat, is not totally logical. We don't think so. The thing here, you can see the market turned. The red is the market turned about 9 months before corporate profits. Now, we'd expect that 9 months to a year. We expect that because, as I said, we're all looking at high frequency data and talking to company management. So when you look at high frequency data, and The red line there is PMIs, purchasing managers indexes, and there's you use much higher frequency, and that's a scale. So that's now the right-hand axis. Below 50 means there's contraction, is bearish. Above 50 is positive, and you can see that the PMIs are probably also turned well before the company earnings. So it's the kind of data we're looking very closely. Are there any signs of green shoots? At the moment, you're not. The PMIs, any high frequency data is still heading downhill. The graph still looks downhill.
Rob, can I just jump in with a couple of questions? Because Donnie is asking about how long do we think it's going to take to get to pre-COVID equity levels. And I think that's quite appropriate. You know, the comment in his question is, do we think we can get back to pre-COVID levels within 2 years? And I think the important point we're trying to make here is we going into a really nasty recession, and it's going to take time for that to work out in the market. So a bear market takes time to play out. It takes time to play out because there's this to and fro of optimism and pessimism. Initially, you have the pessimism of the virus kind of exploding globally, and then you have the optimism that the lockdowns are working and it looks like it's rolling over, and then you have all the QE and so forth. So you have this kind of optimism and pessimism. We think it takes quite a while to play out. I'd say 2 years is probably a bit too quick to get back to a pre-crisis level in equity markets, barring some unforeseen circumstance. But the point being is we don't have to predict that. We don't have to kind of, as a decision, we've got a flexible mandate because we have flexible asset allocation. If information comes through, and that's why I kind of jumped in on the PMI chart, if information comes through that suggests we're through the crisis, a flexible fund, a flexible mandate with active asset allocation can then add risk assets to the portfolio fairly quickly, given the new information. That being said, we haven't yet seen information to suggest, or data to suggest, that the markets will be turning anytime soon. The fundamental economic data is actually still deteriorating. It hasn't even turned. So we don't have to predict it, but I don't think 2 years is a reasonable horizon to be back to the record highs that we were at pre-COVID.
We're still pretty close to the record highs. I mean, US is 6-7% down for the year, and year on year is flat. Whereas when the market turned in GFC, it was down about 55% year on year. And the market doesn't care what the share prices were at the beginning of the year. But the share price is still very high relative to what's happened.
And maybe just to jump in there as well, with Anthony's asking a question around kind of the response to the virus. And yesterday we had Fauci and so forth testifying to the Senate. And I think it really gave the market an impression that it's Anthony's asking about Trump policy, where we're going to go from here, what are the risks? And it does seem like the coronavirus risks play out over a longer period than expected. And so the political response, when do you open, how much risk do you take health, how much risk do you take on the economy, there's no perfect answer. It can't be done necessarily as scientifically as everyone would like. And so we do think that the virus itself, the risk hasn't gone away yet. And you could have second wave, third wave that you've got to be mindful of. And I think if you're looking at PMIs here, the slide, if you run a business, why would you build a new plant now? Why would you invest? Where are you going to get the confidence to expand or grow your business? It's very unlikely. You want to wait for the kind of the health risks to be in the rearview mirror before you start investing or before you start spending. Why would you buy a new house now? You'd probably just wait and see what happens. So this thing takes time to play out.
Yeah, I mean, the point to make, just to keep emphasizing it, if you look at this slide here, the blue, the US market, it's updated the end of April, so there's been even more rally since then. The US is actually a couple of percent up, but let's call it's slightly up year on year. The PMIs, this is services PMI, non-manufacturing PMI, which is much bigger weighting in the composite PMIs. And you can see the PMIs turn probably a little bit ahead of the market. And the PMIs are hard down and going down more. There's no sign on real numbers in the economy where any companies are saying, yeah, looks like it's going well. You know, when auto sales are down 60% and then maybe they're down 50%, no one's getting excited about that. So investment, services PMI, manufacturing PMIs, it's high frequency data you want to look at. But there's a complete disconnect on underlying real economy and where the market is. And we hope we're wrong, and we certainly allowed to change our mind. And we always have permission to change our mind. But just realistically, the market shouldn't be down 4% in the US. There's some shares down a lot more, but then there's some shares up. That's the nature of an index. Similarly here, we don't think, we're not really excited about the values we're seeing here. And bear markets take time. And I mean, I think that's what we were just trying to say. It's not, we've seen bear markets. I've been through a couple of them. If you've never seen a bear market, they just sort of nasty, but you get through it. The first leg down it's giving you a nice little out. Sure, you want to be there for the next, 6, 9, 12 months, your choice. And I think markets kind to us like that. South Africa, very similar thing. There's our GDP and there's trading earnings. And a point to note is that the 2008 bear market, GFC, we were running a GDP growth of about 5-6%. We had almost a balanced budget in South Africa, and our debt, government debt was about 20% of GDP. Now we're in a recession before Corona. Our debt to GDP was going up to 75% on a sort of 1-2 year forecast, and our budget deficit was going to be 7.5% before this happened. And you can see what the expectation of corporate profits are. It's messy and it's a tough environment. And you can see again there that relationship. So we've had a lovely rally. That's great, but even in SA, you're only down, equity markets down 10% year on year. And this is obviously in April numbers. I think we're slightly up from that. So it's not like you're down in the depths here. So what we're saying to navigate it, we 8 weeks ago we were saying the market is too cheap to sell, not cheap enough to buy. Now we just think there's another chance to just not be there for it. You don't want to be in the environment. For a couple of years we've been saying to clients, get out of property shares, and here are the reasons. If you didn't, now property shares have kind of all halved. What do you do now? It's a hard one. That's a hard decision. Because they can halve again quite easily. You don't want to be in that position where it's just not too cheap to sell again and just taking pain, but what do you do? So we think there's an opportunity to avoid it. It's probably the worst economic hit since the Great Depression. I hope it's not. Hope it's just great. It all goes away and we blink. But certainly not. If you look at the facts, we're 2 months into bear market. It's going to be 6-9 at least. That's a bear market rally, and you can de-risk. Funds we're uninvested in our funds. Switch to one of the options is switch to funds that is low equity but active allocators. If you want to take that call to as an advisor to be doing when to do the switching, that's great. We're happy to own that responsibility as asset managers. It's just part of our style. We also think people should utilize the offshore allowance, even though the rand has weakened a lot already, which income funds don't have. But one of the things you've got potential of, it's a smallish chance, but you've always got the risk of some economic dislocation in South Africa because of, the stats I was saying, our budget deficit goes 12-15%, and so you need to keep that. Which is with the multi-asset funds, generally have that at 30%, and the income funds don't. And we're still a bit nervous of SA bond duration. We've been put it on, when South Africa was downgraded, we put on bond duration and made a bit of return, took it out. And so we've got SA government bonds where most of our cash is, but it's a RSA 2023 is very low duration. And just really leaving this last quote from Charlie Munger from what's it, about 2 weeks ago now, from Wall Street Journal. You know, so basically we're like the captain of a ship when the worst typhoon that's ever happened comes. We just want to get through the typhoon and rather come out of it with a whole lot of liquidity. And essentially what we're trying to say, it's not a doom and gloom message, but, you know, you've got a sturdy yacht, you're sailing into storm, you can prepare for it psychologically. If you trim your sails, you batten everything down, you close the hatches, you know, strap yourself in a wild ride, you come out of it. And then there's a good time. If you're on the deck having a beer in your costume, when it hits and negligent towards it, it can hurt you. But it's sailable through. The storms pass, the sky starts shining again, the sun starts shining again, and it's a blue sky. But right now, what we see it's a pretty tough thing to get through, and certainly want to be prepared for it. And there will be great opportunities. You know, two of the one Buffett analogies, you need to buy when everyone's scared. And when the market's terrified, you need to buy and sell when they're very optimistic. Right now, we don't think that some share prices are down, but we don't think investors are scared. Investors are just saying, it's 2008 again, I'll just do nothing. Market's back to where it was a year ago. Who cares? These things, just ignore it. So market's not scared yet. You will get values that we think are superb and opportunity for great returns coming ahead.
Great. So I've got quite a few questions here, Rob, that we can go through. I think the first one from Matepu, just asking what's the kind of downside from these levels. So I think that you're getting to the crux of what we're trying to talk about, as we're saying, looking at the level of where the Aussie is at, given the economic hit we're taking, given the position that South Africa is in, we think that you're getting a second chance to de-risk a portfolio, given that we now know about the risks of coronavirus, we know about the recessions coming. We think that the Aussie is a bad risk to take, and that it would be better to reduce risk and, in our view, sit in a flexible mandate, because there will be a time to buy. We just don't think it's now. But we do think that there's kind of it's crushing bear market, 6-9 months, the market can trend downwards with ups and downs of optimism and pessimism, but a downward trend. So we think a fairly high probability of the fact that we're in a bear market and in a bad recession.
Those are the three last bear markets to answer the question where we think we are relatively to those, and they're all a bit different. Pick one, and the next one, how this plays out will be slightly different to all of those. But for South Africa, down 10%. For US, being flat year on year, it's not totally realistic. There's international markets, the S&P. We think the roadmap on international shares are more like those, and Aussie is going to look like one of those three.
So don't be fooled by technically. If you bought at the bottom and you would have made 20% on the rally, that's what we just consider noise. I mean, if the market had trended, if you look at that red line, and if it just trended downwards to where it is now, without the massive fall in the rally, I think the conversation would be a bit different. The argument that we're in a downward trending market from here would seem more realistic to the bulls. We think it does trend downward from here. And Alfie's asking an important question. You know, there's obviously a mix of valuations within that red line. The Aussie is a composite of some expensive shares and some shares that have fallen 50%. One of them being the banking sector. So banking shares are down 30-40%, depends where you take the starting point. Alfie's saying he still thinks that there's risk of business failure. We agree. Not just business failure, but also, very importantly, with interest rates coming down so much, the interest rate spread that a bank kind of takes deposits and pays a very low or no interest rate, and then lends it out at a higher interest rate and makes a spread, right? So with the SARB dropping interest rates, it means they make less profit. Now, normally when interest rates drop, you lose money on the amount of interest you make, but you make money because people default less. So the problem is we're in a horrible recession. People are going to default more, and you're going to not make as much money on your interest spreads. It's a really bad environment for banks. And we don't buy this. I mean, First Rand recently said they've given 500,000 customers payment holidays. Now, South Africa's that's a lot of the income earning portion of South Africa, and we don't believe in the payment holidays and a default are non-performing loans are kind of, they're blurring the area and they're blurring the accounting based on a health crisis. But normally in a recession, if someone doesn't pay, it's called a default. But because it's a health crisis, it's now being called a payment holiday. I'm not convinced. So I agree with you, Alfie. We're still a little bit cautious, or actually very cautious, around the banking sector. In South Africa, we're not currently allocating towards SA banks.
There are some very, very good banks in South Africa. Corporate profits might not be there. I ran a JC listed company for about 15 years, founded it, listed it, ran it. Right now, I would be going with a Charlie Munger quote, well, guys, it's not about some fancy pants earnings forecast to impress the analysts and the portfolio managers. We're not panicking, but we're just sailing this boat through a storm. And you want to slow the boat down, make sure we don't take a whole lot of water inside the boat, and the boat's still doing okay at the end of the storm. And that's important. You're not just, if a CEO is just saying, who cares? It's just a little bit of a dip. The companies will come through, the good companies will come through, but the profits are going to be a bit scratchy the next couple of years.
Yeah. So we're not calling bank failures. We're just saying you could lose more money on your equity. To be clear, I mean, we've got a great SARB, we've got great financial institutions, we've got very prudent management of our banking sector here, very good quality banks. But as investors, we are investing in a future earnings stream. And so we think they'll survive. We just don't necessarily think that the earnings will be as high as what everyone else is pricing into the assets. We're getting quite a lot of questions around inflation, gold, QE, and so forth. Craig asking about gold. Yes, we do think gold is an opportunity. You just got to be careful with gold. We're very cautious to be kind of, you get these investors that are permanently bullish on gold. We don't think that that's a way to treat gold. You've got to look at gold relative to the price momentum, relative to inflation expectations, and so forth. But in a kind of flight to safety, health crisis type of environment, gold can do very well, especially for local investors. The Rand gold price, you double up then, because obviously the Rand can weaken in a bit of a crisis or sell-off. And so you kind of get Rand gold, we think is a good investment. And we do have a reasonable allocation through our funds into gold. And yes, there was a question around inflation. Are we worried about inflation? You got to be careful on your time horizon. So that's Greg's question I'm answering now. You got to be careful on your time horizon. So in the short term, a recession is deflationary, usually. Sometimes supply risk can cause some inflation in specific areas, but broadly as an economy, a nasty recession is deflationary. Coming out of the recession, medium term, we do see inflation risks, but not yet.
Yeah, that's it. Years out, inflation is something you really want to worry about again, particularly internationally, where the world's got addicted to no inflation, quantitative easing. That's something you've got to be a little bit concerned about it.
Yeah.
But just the gold thing, we've got about 10% in our funds or physical gold, some gold shares in some of them. But I mean, that's about max. Sometimes you have investors want to go 50% gold, 100% gold. That's a limit where we're comfortable. It's a nice non-correlating investment, done really nicely for our clients over the last year. But you've got to be careful. Gold can bite you as well.
Yeah, so we've still got lots of questions. If I don't get to them now, I'll try to drop you a mail. So don't worry if we get to the end and I haven't answered your question, we can pull them, and then I'll try to drop you a mail with answers. The one question I think is important to acknowledge, so just to prioritize that one from Hercules, I'm just going to answer that now. It's this idea around, with QE, there's so much money chasing fewer assets. And so the market has to go up. To some degree, there's some truth in that. But we've got to be very careful, because that's also the definition of a bubble. Now, to time a bubble is dangerous. And I hope this has come through clearly, we manage risk very carefully. We're not market timers. So the idea to invest in equities now, because the QE money has to go somewhere, that trillions that's being printed has to go somewhere, is a very risky strategy. We try and look more fundamentally at the earnings stream of the company. Is it a good investment? Relying on money printing to fuel equities is quite dangerous, and that's why we're very cautious around this. What we're saying is a bear market rally. Yep, the strength of this bear market rally to some degree is probably linked to the speed and the quantum of QE, but that's all the more reason to be more cautious about the bear market rally than to think that now we're in a new bull market, even though we potentially have the worst recession since the Great Depression. That's what the general forecasts are.
Things like corporate tax rates are going up too. Kind of want to factor a couple of things like that in your numbers.
So just a question also from Matepa, a good one. How do we manage volatility? Is it just asset allocation and instrument selection? That's broadly, we think the best way to manage risk is through really good kind of active asset allocation, and then also bottom up, not buying risky shares. That's the core of what we're doing. We don't play around with option structures, getting kind of clever on swaps with currencies and so forth. So although it sounds very simple, we're saying we're not using fancy derivative instruments, we actually think it's the right way to manage risk. We can use, in some of the funds, we can use derivatives for hedging, but broadly speaking, you look at the coronavirus crash, things don't operate normally in a crisis. And so relying on fancy derivatives and so forth, they don't always do what you want them to do. But when you sell all your equities and you buy US treasuries, that does exactly what you want it to do, and it comes with the right outcome. So that's the core of what we're doing to manage our risk is through asset allocation and stock selection.
Briefly, our beta of our equity fund, and our equity selections in all our funds tend to be quite, if you look at the weighted average beta in the funds are quite low. We look at the beta, we're looking at, these are some of the stats. We pull this out of MSCI Barrow. You look at momentum, and you try and look at all of these things, and your end picture, you want to look at, you must have had a lower volatility. So we measure it, how we're doing, but we also look at the construction of the portfolio. And if you've got a portfolio and it's got a market beta of 1.2 relative to the market, it's going to be more volatile than the market. You can pretty much bet that. So you're looking at the stats, and you're looking at the kind of shares you've got and how they combine. That's of the whole portfolio, things like momentum, liquidity, leverage, you beta there, you can see at the top, tracking those through. Obviously, the redder they are, they lower. But we do a lot of work on it. So obviously, we don't have time to do that now. We can check after that.
Great. I think we're going to have to wrap up here. For the questions we haven't answered, as I said, I will try and get to them after the call via email, and we could take the conversation forward from there.
And if there are others, just email them to us as well. Or we've also got a lot of, it's great being on. It's nice to see everyone face to face, but with webinars and Zoom calls, it's really great to chat to clients and people. It's where we find we actually work quite well to do.
All right, guys, thank you very much, Rob and Simon. Thanks to everyone for your time this morning. It's great that we can do this. And as Rob said as well, please feel free to send your questions through. Simon will be getting back to these people whose questions we haven't answered. And we will also be sending out a link again with the recording of the presentation, as well as a copy of the slides. And please feel free to share the slides with your clients. And that would be great. Thank you very much. That's the end of this webinar.
Thanks so much.